Tomorrow's the big day. The Fed is not backing off. Wall Street is working its way towards what they believe the Fed is going to do. Markets are down today about 1% across the board, 0.5% on the NASDAQ. Markets were up a little bit yesterday. They started out down and then rallied into the close, getting ahead of today's sell-off. I think that was a little bit of automated trading, algorithmic trading going on yesterday. Bitcoin's been all over the map. We'll look at the charts here in a minute in terms of what's going on. But the big conversation of the day, well, it's really two things. One is the Fed. Obviously, the expectations are 75 basis points. They have not telegraphed anything otherwise. So that is more than likely, most likely what we're going to see. And Wall Street is finally looks to embracing the idea that the Federal Reserve will hike rates into restrictive territory and stay there. The central bank is forecast to keep hiking rates into March of 2023 at 4.2% to 4.26%. And there is growing concern among respondents that the Fed will overdo tightening and cause a recession. And we'll get into why that is, but higher for longer is the narrative. What we can expect is for the Fed to come out strong with the same messaging as they did in Jackson Hole, that they are taking inflation serious. They're going to do whatever it takes to get it down. They still have a long way to go, and there's going to be a lot of pain. So that's what Wall Street is kind of pricing in right now, is the fact that the Fed is serious. They're not backing down. They're not going to pivot. And the other news of the day is the treasuries, and what's creating pressure in risk assets is the 2-year yield now up to 4% as investors look for that flight to safety and that safety play. As markets continue to unwind and investors are looking at a risk-free 4% yield, that's going to affect risk assets. That's going to affect the real estate market as well as investors continue to move in that flight to safety. So as always, we have to watch the momentum into the close to really understand where investors are thinking and see if anything comes out ahead of the Fed, which I doubt it will. And one of the reasons the Fed has so much resolve is that top economists are all saying that we're not even close to a recession. So the Fed's belief is that the economy is strong enough and that they have not done enough fast enough to really get inflation down. And again, inflation is way more damaging than markets declining a little bit, real estate and housing resetting, those types of things. So this is Mark Zandi. He's the chief economist at Moody's. And he said too many important metrics are signaling positively that for the U.S. economy, and we're not even close to being in a recession right now. He said, when you look at the high job creation numbers, record low in job layoffs, the elevated number of unfilled positions, the high quit rate by workers because they are looking and finding other high paying opportunities, and consider that recent GDP figures are likely to be revised higher, it's hard to think that we're in recession. You've heard a lot of talk potentially around the markets that the technical recession isn't really a true recession where you get layoffs, business closing and things like that. And we're not really seeing that at scale. We're not seeing big layoffs. The only people getting ready to lay off is Wall Street because of the markets and, at scale. So the job market is very strong. Growth continues steady, especially if we get upward revisions of the last GDP reports. And the only thing that is really taking a hit right now is housing, but still not at scale. New construction starts came out today, and they were surprised to the upside. So new housing starts are still strong, even though builders in a lot of markets are having trouble selling, having to reduce prices. But you have to remember, builders are going to keep building because they have to stay employed. These public companies, they are still able to borrow a lot of money. They can average things out across the country. Some markets are hotter than others, so they can absorb a lot of loss in some markets, make it up in others. But at the end of the day, they're trying to keep themselves employed, so they're going to keep building. If they're not building, they're not employed. So we're going to see builders continue to build as long as they can, even as rates rise, and they'll just sell at a loss. Maybe they'll issue stock down the road to cover those losses, but it'll be interesting to see how that plays out. Let's take a look at the charts here. And this is what we've been watching, what I've been watching on Bitcoin. This is Bitcoin on the daily, this major trend line for the downtrend here. Every time the price touches it, it rejects and drops. And we looked at this last time, about a 50% decline. And where that would put us from now is about the 10,000 range. But the big one is this horizontal line here, which is the 2017 high in the 2017, 2018, bull and bear market cycle. where price has been bouncing around, rejecting and finding support and finding rejection. So what we're looking for here is, can price kind of get above here and continue on, or will it come below here and reject lower? And it could do this for a while. So nobody really knows exactly what's going to happen. I think potentially in the risk off environment that we're in, when the markets go to retest the June lows, if those levels break and do not hold, then you'll see the next leg down for Bitcoin when this happens. And markets are working their way there now. This is the Dow Jones on the daily, and potentially right now to break that low, that's another 3.5% decline. That could happen in a day if you get some bad news, and it could happen tomorrow if the market reacts based on what the Fed says. Again, the markets know the rates are going up, and the question is, what is the Fed going to say? What is the FOMC members going to say after the meeting? What's that messaging going to be? And if they say the economy's strong, brace for pain, we're going to continue to raise rates, and the terminal rate expectation is a big one. If they upward revise that to 5% range, then that will be damaging for the markets. Right now, the NASDAQ has about 7.5% to go to break the June low, and then the S&P has somewhere around the similar range to break that low. S&P down around 5.5%. So it looks like markets are working their way down to retest those lows. And again, if that breaks, then I think you're going to see Bitcoin break and go down to the next level, which is in that 15 to 16,000 range. Potentially, if that doesn't hold, it'll drop right on down to that 10, 12,000 range. And then we could start looking potentially for a base in the markets. But the real question is, how long will all this go on? Can we get back to new all-time highs? I know a lot of people are saying and calling for in traditional markets and crypto that the bottom is in, that we've seen the bottom for Bitcoin, we've seen the bottom for crypto, and we've seen the bottom for stocks. And nobody knows for sure. The only thing that could confirm that, and again, one thing to think about is traditional markets have never bottomed when the Fed has been hiking rates. So the markets can't bottom and won't bottom until the Fed is done hiking rates and inflation comes down. That's when your bottom signal will come in. Right now, we've had an orderly unwinding in markets ahead of all of these rate hike expectations. The Fed is not going to stop just because markets have sold off. Markets may test the Fed, as many investment managers, economists, analysts are trying to bully the Fed and tell them they got to stop raising rates, or they're going to send the economy into a recession, depression, things like that. But the economy's strong in terms of what the Fed looks at in those indications. GDP, jobs, number one is jobs. And again, inflation is still way too high. So the Fed, some people are saying, have not done enough fast enough. Other people are saying they've done way too much and they need to stop. And that's what these rallies were all about. When Powell came out and said we've reached neutral in his off-the-cuff comments, off-the-script comments, I don't think you're going to hear anything out of Powell or anybody else other than, we have one mandate now, and that's to get prices down. Employment is taking care of itself. They got to battle prices. So is that pre-pandemic levels to where the market needs to get back to? Is it the pandemic lows? Where does that need to get to? And when you look at, the 2009 bottom compared to the pandemic bottom, that's still quite a gap to fill in, and a lot of work to be done in terms of what the market could, unwind and get back to. And these things take time. The NASDAQ obviously is more reactive because of the valuations in tech stocks and the multiples that those were trading at. So that's what everything's unwinding back to, is that Fed terminal rate expectation. Multiples have to reprice on that. Then you're going to get earnings revisions, and they have to reprice on that. So markets are orderly, unwinding in an orderly fashion to reprice and readjust based on the new expectations. And now S&P is competing with the 2-year Treasury. So there's a lot of pressure on risk assets right now. That's what's going on. But at the end of the day, capital has to go somewhere. So when all these investors sell off and unwind, they got to put that somewhere. They're keeping a little bit in the dollar. We're seeing the dollar, cash. We're seeing the dollar continue to kind of consolidate here, working, for looking for its next leg up. And of course, the VIX is a big indicator to watch. The VIX has gotten nowhere near capitulation levels at all. It's just kind of in this range here. And then, of course, oil is another big one that we're watching. Oil's been kind of working its way down. The question is, will it get down to these $60 a barrel lows, or is it going to rebound back up into the $120 level? And there's a lot of things out there coming into hurricane season that could affect that. Obviously, global affairs and geopolitical risks can affect that, and pricing caps and things and the effectiveness of that. So there's a lot of things out there. The big thing to watch is, let's take a look at this hourly here. And you can look at this hourly price action recently of Bitcoin, and you look at Ethereum, and especially right in these areas here, there's Bitcoin, there's Ethereum, there's Avalanche, Solana, Matic, Cardano, Cody, Link, Crypto.com, Aave, Sushi, Uni, Filecoin, all the Filecoin, ICP, where's ApeCoin? ApeCoin has been deviating a little bit, but pretty much all of the major altcoins and Bitcoin have had the pretty much exact price action. So that tells you this is not retail. This is not retail coming in buying. This is not institutional coming in buying. These are hedge funds and investment funds, algorithmic trading, arbitrage trading across multiple exchanges, because the price action is exactly the same, pretty close on most of all of these major cap altcoins. You can get into some of the smaller caps and see some deviation. And then, of course, you have your meme stock action that's going on with AMC, GameStop, Bed Bath & Beyond, Mind Medicine. They had a reverse stock split, continuing to drop. So a lot of stuff going on out there in the market right now. And if you take a look at, some of the major stocks out there like Apple kind of dancing around, there's the June low for Apple right here, had a big rally, unwinding that move. So we'll see if that gets down to test those lows. ARK, the biggest, one taking one of the biggest hits out there, still dancing around those lows. So we'll just have to see if that breaks. And then, of course, MicroStrategy issuing more stocks to buy Bitcoin. Let's take a look at MicroStrategy. That stock continuing to test these June lows. So we'll just have to see how all these things play out and where the dust ultimately settles. And that's the big thing, is that holders like highly leveraged holders like MicroStrategy have not been tested yet in terms of margin calls at these levels. So Bitcoin really needs to get down to the next level to really start testing some of these larger holders that are leveraged on margin. The other thing with interest rates where it's at, corporate credit could come under stress. And a lot of these companies that aren't profitable, that have been living on debt and credit, and real estate investors as well, if they have to refinance that debt where the rates are now, they're not going to be able to survive. So there is a lot of potential opportunity when it comes to corporate debt, corporate credit, and real estate debt as well, when we see some of that reprice and these companies retrade based on that. So that's going to wipe out equities and stocks when those things happen. So there's a lot of risks out there still, a lot of repricing. Tech is one of the biggest areas. That's why ARK is down so much, because of those zero earnings companies. A lot of zombie companies out there that aren't going to be able to survive in this high interest rate environment. So the key is, where do the Fed terminal rates go? How long does this last? And will we end up in a recession? And we don't know the answer to those questions, because this is all new, uncharted territory that we're in right now. Everywhere, the housing market with inventory levels being at record lows and demand dropping at the same time. We've never seen that. Seasonal inventory levels are not rising like they normally would this time of year. And even with interest rates rising, you're still seeing some markets where properties are still selling very quickly. But in general, on average, days on market are still going up a little bit. Inventory levels are rising a little bit, but new listings are down, and home values are up, or still increased year over year on average. When you look at the national average, but every market's different, every asset's different, every area is different. So real estate is hyper local. And we are still, like I said, these are just uncharted territories right now. So nobody knows what's really going to happen for sure. All we can do is watch, take it level by level, be data dependent, just like the Fed. And what you can do is be ready with your capital, preserve your capital so you can take advantage of opportunities when they come along, and don't buy into anybody's narratives. Do your own research and listen to a broad spectrum. You're not going to see all-time highs anytime soon in any asset until the Fed is done, inflation is down, and interest rates have stabilized. So that's when you know the bottoms are going to be in. That's when you can look for return of the, I don't want to say bull market, because the bull markets have been driven by Fed easing and Fed liquidity. So the Fed stopping is one thing. The Fed juicing the markets through low interest rates and QE is another thing. So right now, the first step is we have to get the signal from the Fed that they're going to stop. They're not going to signal that today or tomorrow. What they're going to signal is higher for longer, and we're going to continue to do whatever it takes and be data dependent. So right now, the markets are working its way towards that. They have not priced in the effects of what the Fed's done working its way through the market, because that does have a lagging effect, and we haven't seen immediate effects yet. Inflation is much stickier and stubborn, core inflation, than they anticipated and thought, especially in rents and housing, things like that. So they still have a lot of work to do. So we shall see. And these are the things I'm looking at. I'll see you in the next video.